All right, let's take a deeper dive into what's moving markets. Hot topic today. I want to bring in Jay Woods, Chief Global Strategist at Freedom Capital Markets, joining me on set. Jay, always a pleasure. Thanks for doing this.
Always great to be here.
How do we make sense of this market?
Right now, if you want to put it in a bigger perspective, we've had 2 consecutive quarters of 10% growth in the S&P 500, and we're pulling back a little bit. This is a normal retracement. You add headlines to it with geopolitical concerns, and you get a little angst. We've had 2 consecutive days of pullbacks of 1%. Pardon me, first time that's happened since October. The S&P 500 did break the 50-day moving average, which has a little of us concerned. It had a 110-day winning streak. Didn't realize this. That was the longest since 2011. So we've come far fast, and now we're digesting some of those gains, and we're focusing, get through some of these geopolitical events and focusing on earnings, and we've got quite a few of them today.
I looked at the close last night. The S&P down 3.9% from its recent intraday high. So a bit of a pullback, but not a correction. Do you think that this is a healthy retracement?
It's a healthy retracement, yes. You don't like to live through them, and now we're getting close to 5%, and then you're like, okay, maybe this could be more than that. I don't think it is. We test 5,001 in the S&P 500. We were cheering that not too long ago, but now it's a 5% retracement. These are normal, healthy corrections you see 3 times a year on average, and then you get a 10% correction once a year. We had one last year, and when did it happen? It happened when the 10-year spiked above 4.6%, went to 5%. That was last October, November, and that's when we bottomed out. And that's the thing that traders are watching the most, that 10-year yield, and it's climbed back towards 5%, and then it's picked up speed over the last few days. It's calm today, thankfully, but that could dictate how things are going, and that's what's keeping the small caps down, it's keeping the NASDAQ composite down, and it's putting pressure on a lot of the smaller names.
So let's walk through some of the major factors, obviously in focus for investors, data, namely inflation, earnings, and geopolitics. But starting with inflation, you've been watching this data closely. How sticky is it? How concerning is the inflation data?
It is sticky, and you look at the CPI first. That's the one indicator. That's not the preferred inflationary indicator, but it's preferred by traders because that seems to move the markets the most. CPI came in hot 3 months in a row. That's not the indicator we want to see for those that thought we were going to get 3 or more rate cuts this year. Now we focus to next Friday, the PCE number, which is the Fed's preferred inflationary number. That has been trending down and sideways, 2.8 in the core. We'll see if it can drop again. If that happens, then we can talk maybe in June we'll get that 1 rate cut. But people banking on these rate cuts, they kind of been pushed off to the side because the economy is doing well. But now we focus on earnings and geopolitical events, which are clouding things. But the earnings have been coming in pretty nicely so far, but it's not taking us that next leg higher. It's not the tailwind we had hoped it would be.
A big question that I have in the market is how these tech earnings shape out, because we got through the banks. They always kick off earnings season. Every bank is different. We know, kind of mixed, I guess you could say. But technology very much drives the overall path of the major indexes. What are we expecting from these tech results?
Well, we're expecting blowout numbers from the tech companies. That's what we've been given. Now, do we react that way? Let's just look at the poster child, NVIDIA. That went sideways for about 5 months. It was up 235% last year. But for 5 months, it did nothing until the beginning of this year, and it broke out over 500, up 70+% as we speak. They may pull back. Let's see what the bar is set. It's about the guidance. And right now, they've continued to guide the Metas of the world, the Microsofts of the world, NVIDIA. It's not the Mag 7, but those big name tech stocks continue to deliver, and we're in that lull before we get to them. So they've kind of just digested where they are. They haven't pulled back too much, but that should be the next leg to lead us higher. And if it doesn't, then we may have to cycle another quarter before we do. And as I said before, we're going to sideways is a direction. And now we may find that sideways zone between, say, 5,000 and 5,250. And wait for that next catalyst to take us higher later in the end of the year.
So it's interesting because you mentioned the last time we had a correction of 10% was in October when we saw this Israel-Hamas war really take off.
October 7th.
Now, obviously, we're seeing escalating tensions, including an attack over the weekend, thwarted for the most part by Iran on Israel and awaiting Israel's response. That's the news that's out there. So what does that mean to investors?
Well, that is why traders, and that's why the market reversed course yesterday. We had 1% dips in the S&P 500 this year, and Friday was one of them. Wednesday was one, and we rallied. That yesterday was the first time we did not rally. So there is panic here. We are waiting for an Israeli response, what that would be. People were kind of hoping, I know Washington was saying, just hold off, you thwarted this is good. If that response causes more escalation, then we're concerned. And usually when the old expression, when the missiles are in the air, we saw it in Bitcoin this weekend.
Yeah.
When we knew the attack was imminent, Bitcoin traded from 68,000 to 68,000, rallied. Art Cashin, a legend down here on the floor, used to say you buy when the missiles are in the air and talks about the Cuban Missile Crisis. We had that this weekend, and then we got a rally. So those people that bought that dip were rewarded. But as you're anticipating something like that, the initial panic, the initial reaction is to sell and then hope for the best. And we got a good result, but now another possible response, and that has traders on edge. So we're watching the tape, the news wires closely to see what happens. And if something happens, we'll probably get another small knee-jerk reaction lower and then see where the dust settles from there.
For investors with a long-term horizon, Jay, what would you tell them in terms of where we are on this cycle? And even though we're seeing what someone called a healthy retracement now, of course, driven by the headlines, where could we be down the road?
Well, those are my favorite types of investors. You and I do this for a living. We watch every day-by-day tick and every earnings, every number. Long-term investors, this is a healthy correction, and I think this is a dip that should be bought. Now, we are in the fourth year of a presidential cycle. Yes, controversial election. We had one in 2016. We had one in 2020. And guess what? In November, in that fourth quarter, the low was on election day both times, and we rallied. I anticipate a little angst, a lot of great headlines between now and September, October as the election cycle really picks up. But I think that we are poised to finish the year strong after the strong start we had. So for the long-term investor, just ignore the headlines, put on some earmuffs, and buy those companies that you believe in that have had solid earnings.
Yeah.
Some of those tech names, some of the names in the financial industry. Goldman Sachs did great, had a nice day yesterday. We'll see if it can continue. But over the long term, I think the setup is there for them to continue, for the next 12 to 18 months on a nice upward trajectory.
I know you mentioned Goldman, some of these tech names. Any other sectors or stocks that you think do look attractive?
Well, there are some there are some healthcare plays. You look at elder care, HCA. That is the most. It's the fastest growing demographic, if you will, the baby boomers. And so we need to take care of the Stryker for artificial hips. Those are things that, you can look at as safe plays given the growing demographics. I think Amazon is still a phenomenal play, and those tech names over the long term, the Googles, the Metas, the Microsofts, and the NVIDIAs, those are where you want to be. And then if you're looking for some action, watch Netflix this week. Netflix has their earnings, and the last three earnings, you've seen 10% pops. One down, two up. And then what it's done after that pop, it's trended in the direction of that pop. So if it is the, gap higher, you probably want to play that gap because the trend continues higher over the next quarter. So I'm watching that closely, and then UNH had a nice day. Let's see if it can hold on to those gains. We saw some pullbacks yesterday, and the geopolitical concerns may halt some of these rallies right now.
Yeah, it's interesting. All right, Jay Woods, Chief Global Strategist at Freedom Capital Markets. Jay, thank you as always.
Always great to be here. Thank you.